Welcome to the Second Bite podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Welcome back to the Second Bite podcast. I'm very excited. We're going to be a little bit different today. Ali Manouchehri is my guest today, who is the CEO of one company. We're going to talk about his role as a founder in Zoomph, which is a fast-growing, rapidly growing company in the, I guess you would call it the marketing tech space, the MarTech space. Is that fair?
Yeah, I think it's that's fair to say. It's more, obviously niche today in our journey and sports media marketing landscape in terms of media measurement.
I want so here for our listeners, right? Most of these, Ali, we talk about when somebody sells their business and they roll forward some or they don't or whatever the case may be. In this particular case, you're going to give us a very thorough and basic education on raising a successful round from venture to grow the business, or also known as growth capital. So as we jump into that, why don't we start with an intro into Zoomph, who Zoomph is and who you serve and what you do for them?
Yeah, no, thank you again for hosting me today. Excited to talk to you about Zoomph. Zoomph is a, data platform with a mission to measure and value the digital world. There's no surprise in how fast content is created today, and where we really break ground into is the sports media landscape in terms of measuring the value of these sports organization, teams, leagues, brands that invest into the sports ecosystem in terms of helping them really unlock the ROI they get from these investments that they do into this exciting and evolving space of sports and media today.
And you unlock that ROI, first of all, by understanding kind of the return or what's going on. Can you give an example? Because you talk about relationships, and as I've started to come to understand them better, they're really pretty interesting. Can you give a couple examples?
Yeah. Once you are at Zoomph, you never watch sports or, shows that you binge with how market placements are done with logos. And it certainly changes your mind in terms of how advertising is really evolving and looking at the sports evolution of sports no longer just being about playing a game, but think of it as a media platform, right? There's a fandom. It's a concept of a religion of how we feel about our sports teams. And the sports teams, obviously, they bring a lot of attraction into brands that want to advertise, before, during the mechanical marketing era to the digital marketing, where now you could now do various content series on social media, do the product placements. This segment of our highlight is brought to you by this partner of ours. So when you look at the sports, a sports team, they got 60 to hundreds of corporate sponsors buying various types of assets, right? In the arena, you see the LED, you see the floor, you see the sideline, you see the big screens, you see the tunnels. But you also go on social media and you see an overlay on an Instagram, and a reel, a short on YouTube. So when you think about all this content that's being created, how do you now collate this data, analyze this data, leverage your algorithms to provide them a media measurement and value for that data that these sponsors are getting in terms of return, in terms of ROI? And Zoomph automates that with our technology platform, our computer vision, our NLP, and our other algorithmic ranking systems that provide this level of quality data for our customers to make decisions. So we become a really important part of their daily lives to measure and value their digital footprints across all these various digital channels.
And so your customer then, is it the advertiser? Is it the sports entity or the property? Who's writing you checks?
Yeah, no, sports teams, obviously we have a lot of sports teams across all major North American sports. Because you have the sports, and the more you go into sports, there's an opportunity for us to expand into the leagues. Now the leagues look at it to say, we want to standardize our measurement, right? There's a reason the Dow Jones Industry Index is out there, right? There's a standard to that index. And, think of Zoomph as that Dow Jones Industry Index for the leagues, for the teams. And when you get
MLB, we're in baseball season. How could you give an example using MLB or something else of how they standardize that?
Yeah. So, some of those leagues that we're mentioning, I got to be careful on NDAs and who likes for me to mention their names, but we do have a lot of leagues, but we also have a lot of their teams. And how they're going to look at it from a league standpoint, they want to measure the value of all their various teams in the league, right? And now they're going to come up with various techniques of, how are my teams effectively selling their sponsorships and asset classes? So we all have similar ballparks in terms of layout. We all have different areas, of the backfield and behind the mound and behind the catcher, all the different areas that we have, the scoreboard, all that. Now you can see there's a standardization of how you want to measure that data and how well are the different teams doing. And now from a league level, how well can you educate all your different teams to maximize their ROI in terms of the techniques and who does what in terms of sponsorship?
Based on best practices, because the San Francisco Giants are doing the best job in the league, just to make up an example, they're doing best at outfield wall placements, and they're doing the best because of these attributes. And here's what the Mets should be doing and the Twins should be doing, and so on.
From that standpoint, and then take it to digital, which now you're kind of unlimited in terms of your level of creativity, because you still have amount of assets you could sell in an arena, a ballpark, a stadium, right? But when you go digital, how do you now effectively maximize profits and maximize the ROI for your customers without over commercializing and diluting your digital content and creating too much content? So what's the right amount of content to monetize with your digital overlays and not piss off your sponsors?
Sure.
Right.
And we could talk about that. I could with you for an hour, but let's focus on the economic part, right? Of a guy who's building a business. So you're a SaaS business, right? So
Correct.
It's access to the platform. As a lot of people know, there's a bunch of investment before you get to the promised land there. So if you take me through, if I recall, you raised a small friends and family round, then you raised an A round, and right now you're just about completing a second round or a B round. Is that right?
Well, yeah, we did the seed round, and the seed round, we figured out how to really maximize and invest wisely that seed money we had done. We did a convertible note in between the Series A round, which we're doing now. So we're not at a B round yet, but we did do a convertible note. This July will be 2 years. And we have plenty in the tank in terms of that convertible note and how we managed our cash flow. But we felt in terms of the things that we're trying to accomplish, gaining the right type of market share, build the right type of valuable capabilities for our clients, we felt that a Series A was timely for us to go and do that. And which is interesting because, timing of the market and the macro environment looks kind of scary to go and raise money. But, we kind of have the skin to handle the different storms today.
Yeah. And so in your space, in the SaaS space, right? Companies typically trade when they're raising money on a multiple of revenue. Is that what you experienced as well?
Yeah, that's fair.
And so you guys, can you say how much the raise that you're looking for?
Yeah, the multiples have changed, right? We've been fortunate that every single year for the last 4 years, we've received an LOI, whether we've asked for it or hey, we really love what you guys are doing, and 1 + 1 could equal 5 here, right?
Right.
So let's sit down and try to figure that out. And the multiples have changed. You know, in the SaaS business, once you hit this 5 million ARR level, the multiples tend to kind of start going in your favor. 10 million more in your favor, 20 million more in your favor.
Because you guys are roughly about half of that, Ali?
We actually just exceeded over 5 million ARR.
That's fantastic. All right. So while the multiples might be compressing, you've gotten over a hurdle rate into better multiples. Is that fair?
Absolutely. And, you know, today's multiples could range anywhere depending, again, you know, your financials. Are you profitable? Are you almost break even? You know, what's the path to profitability? A lot of things into consideration. But around that size, you're looking anywhere from 5 times to 7 times in terms of revenue. Yeah.
Yes. And so if you're 5 and the market's at 5, maybe that's a 25 or 30 something $1 million value. How do you guys think about the amount of the raise? Is it, here's how much we need to get to profitability, here's how much we need to get to version 3 or 4? Is it, let's go get as much as we can? How do you think about that?
Yeah, I mean, you know, I think, you know, sharing this with, you know, other founders that are out there, you know, either starting or they're trying to figure out how to make their next move. You know, my recommendation is spend time and come up with a very thoughtful use of funds plan. A use of funds plan that's very aligned to your strategic plan. And don't go spend and build a 30-page strategic plan. Draw it up on, you know, just one sheet of paper of what you want to do with your people. What do you want to do with your internal operations? What do you want to do in terms of the customers you want to go after? And then what type of financials do you really need to plan for to be able to really create the strategy map that's out there? And then kind of look at the way you want to measure what matters to you to measure, and then what those outcomes that you want to get. And then you can now sit down with your team, with your product team, with your customer success team, with your sales team and your marketing team, and really now come up with a thoughtful use of funds plan of, you know, how do we take care of our people so we could retain the top talent? What do we do with the funds to go and attract top talent? What else do we build in terms of culture and benefits that could keep this group together, right? The glue that keeps everybody together. And, you know, obviously the mission being really important, that everybody believes in the mission. And then probably the next area is the innovation, right? What are you going to innovate that your customers are going to appreciate and want more of that because you're solving more of their problems before they reach the problem stage of their cycles, because the space is evolving very much. And then we're a data company. So when you're a data company, you're always looking for unique data pieces of bringing this data piece, making it have a baby with this other data piece. And now you've given, you know, birth to this really unique data piece that tells a different story of how you're measuring and valuing the digital world. And that really is a summary of probably the outline of our use of funds plan at Zoomph, of how we came up with it. And now you realize, okay, well, how much of the company do you want to give away by raising this money on this multiple and getting this money in? Do you need 2 million? Do you need 5 million? Do you need 10 million? Do you need 40 million? What do you need to execute it? And for us, we weren't looking for a majority investor. We were looking for a minority. And then we went through, that's a whole different story of how many different meetings and how many different no's until we found the right strategic partner.
And so can you share the approximate number that you decided on that you needed to raise?
I should have pulled up my HubSpot CRM where I track it. Goodness, it's probably well over 70 some various groups, all different flavors, from, you know, groups that you get excited because, you know, they have this gravitas of the different brands that you kind of look at and you're like, wow, these are amazing brands that have done amazing things out there. We've talked to large private equity, large venture caps that could go from Series A to the whole alphabet if they wanted to do. But eventually we kind of settled on a group that were former operators that got into the venture aspect in terms of really growth equity, that they really understood vertical SaaS market and how to scale that, because they were very successful at what they did in terms of building their business and then exiting to a very Fortune 50 giant in the industry of how they did that. So that got us really excited about them. We got them excited. And after 70 some different meetings and no's and maybes and take you for a ride, we went down this journey with them, and we're pretty close to closing now.
And how much were you looking to raise? Did you determine that?
Yeah, I think when we looked at our use of funds plan, our first version was like, holy cow, how do we go raise $10 million, right?
Yeah.
And then we get back to the drawing board. I was like, all right, man, let's take it easy. Let's be realistic about what is it going to take for us to get over the 10 million ARR and be profitable, right? So the path to profitability was very important for us to build into our plan. And when we did that, we realized we didn't need as much money. I have a really good friend that's raised a lot of money. I think their first round, they raised 40 million. And one of his biggest lessons learned is, Ali, I raised too much money. I raised too much money. And believe it or not, a lot of people said, well, it's a good problem to have. He's like, it's not a good problem to have, because the expectations are different. And I think, we took that to heart, because we had great offers from a majority standpoint to a minority standpoint that wanted to put more in. But we felt that, that 4 to 5 million could be the right amount that could get us to execute our plan.
So as I think about it then, roughly you're 25 to 30 million of value in your mind. You're going to raise 4 or 5. So that's kind of in the 20-ish% range, right? So when you started these conversations, did you go like we would when we're selling a company? Did you go with a deck and say, here's Zoomph and how great we are. We're looking for $4 million and we're willing to give up X amount? Or do you just put it out there and say, if you're interested in the company, let's have a conversation about economics?
Yeah, it's, I always felt comfortable saying how much we want. I was never comfortable kind of like being on Shark Tank to say, this is how much I'm willing to give away.
Right.
Let's figure that out. Let's figure that out, because maybe you're willing to give away something more to gain a great partner. Because, raising money, you're going to have to realize they're going to be partners. They're going to be in your business. It's kind of like marriage, right? They're going to be in the bedroom. You're going to share that pillow with them. And that pillow is for laughter and some crying together. And
if it's the right partner, you want them in the bedroom, right?
Absolutely, right? So I never came out explicitly and say, hey, this is what we're willing to give away. I think we along the way figured that out. And it's another thing that I've kind of learned through this process. You start also understanding upfront, and probably, if I could take after the 75th meeting and go back to the 5th meeting, I'd be like, well, how much do you all want to get out of this? Like, when you make an investment, what is the average percentage you want to own of that portfolio company that you're going to bring in?
Is it a percentage for them, or is it a total gross return on invested capital?
I think ultimately it's that, right? The total return.
Yeah.
But to have the total return, you have to have a total percentage of ownership into something, right?
Mm-hmm.
And that's when you kind of realize, you're like, okay, well, is there criteria to always make an investment from a philosophy that they have? Is it, hey, at a minimal, when we make an investment, regardless of the check size, we want to own 10% of the company, or is it 20% of the company, right?
I see.
In another business, that I've raised money in, they were very clear about the percentage upfront of what they want to do. Like, we're going to invest this much, but this is how much we want.
Okay. So now let me ask a quick side question, and then we'll get back on track. In your mind, so you are also the founder and the CEO of a pretty substantial, several hundred employee government contracting business. You're also not a couple years out of college. Do you think that your age and experience helped in a comfort level with your investors that said, hey, this is a responsible, mature guy that knows how to operate and grow a big business? Or is it perhaps the other way where they said, God, look how old this guy is. No way we're investing with him.
Yeah, I don't know if I'm that old yet, but certainly, running a 100 million plus business with, 430 employees. And then you obviously have this other baby, in Zoomph. It all becomes about the great team you built, right? I'm very fortunate to have some amazing co-founders, Amir Zanozzi, Nick Cronin, Thomas joined a little later, but Thomas is with us, Thomas Matthew. We recruited and brought on an amazing chief revenue officer, Mike Pica. We've just built a very high performing executive senior leader team, right? And ultimately, it's not just about the confidence of Ali. It's the confidence of who's around Ali, right? Who's around that are running it. I mean, day to day, Amir is our fearless leader, right? I mean, this guy runs the show, right? He is Zoomph. You cut that guy's skin, he's going to bleed Zoomph, right? And I think that's what they get comfortable with. And, during this journey, do people question like, Ali, how do you CEO two companies? Absolutely, it comes up. But it's a matter of like, look, that's just my life. Like, I'm not going to go change that. Like, it's like having 4 kids. Well, shouldn't you have 2?
Yeah.
Sometimes I think about that, but those 2 nights, there was like, we were blessed with 2 more,
So let me ask this then. So you raise, let's just, for conversation's sake, let's say you raise $4 million. Your VC group, your investor group, did they write a check for 4, or did they go pull other people in? And was that part of your conversation with them and important to you up front?
Yeah, I think part of our strategy was we wanted a lead investor because we have an amazing group of seed investors that came in, Todd, that we wanted to take care of them, and really the trust and the patience they've had with us, we want to maximize profits for them as well. So for us, we didn't want to check from one because our other investors, frankly, wanted to invest. And it's amazing the journey we've been through from finding a lead investor to today being oversubscribed. And, that's another problem. It's a good problem to have to be oversubscribed, but we wanted to take care of that. So for us, when we went into these conversations and we turned off some investors because we're like, we just need you to be a lead investor for this portion, and this other portion, we already have commitments on.
So the seed money, those seed investors said yes. And when you added all those up, let's just make it up, that was $1 million. So you just need the other guys to come in with 3 million.
Yeah. I mean, plus or minus, it's more plus than minus in this case, but that's exactly it, right? The other ones wanted to continue investing because they've seen the growth, they're excited, they've learned what Zoomph does. At first, they're like, hey, cool tech, we'll tag along, we really like you guys. And then they're like, you guys got this client. They're seeing the updates on a quarterly basis. And like, holy cow, like you guys are crushing it. Like we see you everywhere. And
so those early investors, those seed investors, now they all converted into the A round?
Well, there's different flavors. So like, there was the first round we did was a seed preferred, right? And this round that we did a convertible, and then we're doing a Series A preferred as well, right? The only difference is when you're getting more money and larger investors, obviously they have a level of seniority in terms of vote, right?
Yeah.
but we try to at least keep the preferences all equal as much as possible to have that.
I'm sorry. Could you explain what you mean by preference?
I mean, I give you $1 million and there's certain preferences I want in terms of what the operating agreement looks like, certain decision making. Am I comfortable to give you $1 million and you have the ability to make a decision on making $1 million investment? Or is there, you have to come back to the board and for every $250,000 decision to do that? How the board votes, right? What the board structure is. The certain amendments into your operating agreement that you have. So the preferences, you look at, you want it to be fair to them because it's fair. They're writing a check. They're putting their money onto your balance sheet. And you want to make sure that you have the autonomy as an executive team to go execute versus always coming back, Todd, I need to go make a hire and a salesperson. Is that okay?
And so one preference I'm used to hearing about is that when somebody puts in $4 million, they say, hey, I want the first $4 million out. I want to make sure I'm going to get my money back because that's what I promised my investors. Is that pretty standard?
I think so. And I think, these days, the first thing our law firm said to us are, Ali, these are great. This is a great term sheet from what we're seeing in the industry, right? Because people are getting very nervous with the economy. So the preferences are there. There's interest that's there in terms of, does it feel like they're double dipping as investors? But ultimately, as executives, you have to execute and make sure those preferences that they have there to protect their limited partners, that they actually owe people money too, right? The returns on their money. So you really got to understand their mindset as investors as well of why those preferences are there. Because the first time I raised money, I hated those preferences. I'm like, what in the world? You're like triple dipping here, right? But then you got to kind of understand why those preferences are there. But here's the thing that why those preferences don't matter. Only when you could execute and grow the business. If you could take that money and go maximize it and maximize profits for everyone,
the preference never makes an impact.
It really doesn't make an impact, right?
Hey, can I ask, you liked your law firm, is that correct?
Yes.
You want to give them a shout out? Who is your firm?
Yeah, we use Cooley. We've been using Cooley since day one. We love Cooley in Reston, Virginia.
Yeah, and who'd you work with there?
Mike Lincoln brought us in, and then now we're Brian Burke is our OG now under the Godfather himself, Mike Lincoln.
Yes, Mike is very well known here in the DC area. And you said it was Mike Burke?
Brian Burke.
Ryan Burke. All right, excellent. So you talked about board. Can you describe, so your investor now, are they going to have a board seat? And how big is the board? And did you make the board bigger?
Yeah, so again, preferences, going back to preferences, right? So in this instance, Zoomph is a 5-member board. And, really, if you think about it from our side, we have 4 external directors from day one, and I represented really the Zoomph seat. But it was a team that we kind of assembled, and most of the individuals that initially were there were individuals that had invested into Zoomph, right, during the seed. Along the way, we kind of changed it up. We brought in other independent directors that could help us with our strategy as well. Sometimes when you initially start a board, you feel very comfortable with specifically people you feel comfortable to put on a board, and you're not as detailed of what do you want out of the board other than they put money in the company.
Because you don't really know, right, at that point.
You don't. And again, a lesson learned, if I go back to Ali 5 years ago, 6 years ago, is, hey, your data company, who on your board could help you acquire better data from the industry? Hey, you're now pivoting into sports. who could open up doors in sports for you faster than anybody else to help your sales organization build a better pipeline, right? Who internally could focus on helping, Amir and other internal and external operators scale the business on that. So along the way, it took us a while, but we were able to do that. But going back to your question, our incoming lead investor, one of the preferences is they want to have a board seat and an observer, right? So they could have someone else also from their growth equity team sit and observe in that. And then what we'll do is they'll meet with the rest of the board. Obviously, there's some changes we have to make with the board. And now we're going to also together agree on what we need, and let's go find the right independent director to come and help us. But we would still remain at 5 versus growing it.
And then I wanted to spend a couple minutes. You had mentioned to me that the option pool is now going to be trued up to 10%. So yes. I'm curious, what was it before? Who drove that decision to make it 10%? Are you happy with the decision of 10%? Can you just talk through that a little bit?
Yeah, I mean, I think the secret to our success has been surrounding ourselves with smarter people and being able to keep them together, right? And even day one, when we started it, our option pool was at 15%. And over time, anybody that joined, right? I don't care if you were a junior customer success or you came in as a chief revenue officer and everything in between.
You're an owner of the company.
Everybody owned a piece of the company.
Wow, that's right? Great.
And as you continuously did extraordinary things, we would also say, you know what? Part of this package for this year is we're going to continuously give you more equity, right? So that pool over time kind of got smaller and smaller. And one of the things that we both agree, the lead investor coming in and from our side, is we want to increase the option pool. And we want to increase the option pool to something meaningful. And 10%, in addition to what's left in there from that 15%, is a significant amount of money that or equity that we have set aside for our workforce to feel ownership into the business as well.
So am I thinking about it right? Let's use the same numbers we've been talking about, 25 million of value, 10%. So roughly there's $2.5 million of value in the option pool just replenished.
Absolutely.
And so, I'm sorry, I was going to ask, so if I've been with you for a while as a junior success guy and I've got a few shares, do those get cashed out or do those roll forward, or how does that work?
Yeah, they roll forward. And, over time, as you raise money, certainly there's some dilution that happens along the way, but guess what happens? The price you came in, it's much more significant. I mean, just in the last 2 years, we've increased the value of the company. If you think about it from like a stock, publicly traded stock, over 80%, right? You can't say that too often about what's happening in the market, but it's also another validation as we go through this. It's a validation for the team to understand that what they have, the value is increasing.
Right.
And every quarter we actually talk about it in our town hall in terms of how we're doing this, how this is increasing. And what the employees have asked is, hey, help us understand that better. So what we're going to do is kind of like treat our workforce like Wall Street analysts. We're going to tell them how this thing is growing.
Right. And that just gets everybody excited.
Yeah, absolutely. When you're growing and, everybody enjoys being together and the culture keeps us together, you share as much as you can and be transparent. That's kind of the way we've built the business.
That's great. Tell me, because you hear this a lot, pre-money, post-money, blah, blah, right? That kind of stuff. So can you just expound on that a little bit? You raise money obviously before you got the money, it was a pre-money value. And now is the post-money value, for example, if you raised at 25 million and you raised 5 more, does that mean your post money value is 30 million? Is it that simple?
I mean, it's that simple. It's not that complicated at all. That's exactly it, right? This is what you agree on the valuation is. This is how much money I'm bringing in. And then it's just a simple math plus, and that's what your post valuation is.
So if I'm the investor and I stroked a check for 5 million against a value of 25, do I own 20%, or is it my 5 against that 30 million of post value?
It's really, obviously they come in at that pre-value of what they have. So now they gain the upside of the post value, right?
That's helpful. So, we talked about a lot of stuff, which was really helpful going through this. I wonder if you had maybe 2 or 3 things that you looking back would say, I wish I would have done this a little bit better, a little bit sooner, with a little bit more conviction. That would be, a helpful takeaway from anybody listening.
Yeah, I think leveraging your initial investors, our seed round, we should have probably spend more one-on-one time getting to know our kind of investors. And you and I are fortunate because, there was good gravity that brought us together, and you and I have built a great relationship over the years. But I feel like probably that was a good thing that we should have probably done more proactively. And the other part was...
And what would you have done? Because I know you communicate with your shareholders once a quarter. I know you've done pretty good communication and you've improved everybody's value. So what would you critique yourself on?
Probably asking for more referrals and better connections and do the ask, right? Don't be afraid to do the ask and reach out and spend time, because you raise money and then you go into execution mode.
Right.
You're relentless about focus and execution. And you got all these investors that put money in and they want you to be successful. So go spend time with them too. So probably balancing my time a little bit more effectively. And I learned that when we did the convertible round, we brought in more new blood than actually from the previous investors, right? A lot of the other seed investors came into the convertible note, but we brought in some new kind of investors for the convertible note that, wow, I mean, they've been such a blessing of when you bring individuals in and they're not afraid to make those connections and they're not afraid to learn more about your business. And once that is kind of balanced out, the referrals we got from those investors really put us on a path that eventually brought some really good venture capital groups to the table for us.
Any lessons you would take away from talking to 70 groups? Is there a way to shortcut that? Is there no way for a shortcut? I thought the idea of, making sure that you have a very good use of funds example or explanation was a great tip. Anything else you would add there?
Get feedback from them. Even if you get the no, understand the why they told you no, right?
Yeah.
What is it that you could learn? You spend this time. A lot of them take you for a ride because they're curious about a market, right? Everyone will say, I'm interested. We are excited about this market space. And they unload a bunch of things on you. They learn so much about you, but you never learn anything back from them. So don't be afraid. Even if you get the no and you want to move on and you're like, screw this, I don't want to waste my time. No, do waste your time. Understand why the no. I probably learned so much getting from the no side, asking them feedback on how they would improve our pitch deck. What did you like about it? What did you not like about it?
You think, and I say this to clients all the time when we go through a process, by far, it is the greatest consulting you could get. When you talk to somebody that has a checkbook, has a ton of experience, and doesn't need to kiss your ass because you're the customer or the client, they will be relentless and brutally honest about what they like and what they don't. And to waste that experience, it's actually, I would say, probably impossible to waste that experience, because any entrepreneur, when they realize somebody's engaged to understand their business at the beginning, we'll ask them, for example, you didn't invest, you don't like it. How come? And there'll be some that say, well, you're not 5 million of ARR, so we don't do that stuff. Others might say, whatever it might be, but they're all helpful, right? They really are.
And you know which ones to dig into a little bit more that you really genuinely feel a good connection, even though you got to know, versus some of them just know everything and, they start picking you apart in terms of your metrics. Why is your gross margin at 95 and not, 105, right? It's like, why is your net retention only at 102? Well, what should our net retention be? 114. And I want to sometimes be like, where the hell did you get 114 from? Like, tell me who publishes.
They got a guy. It was the guy that they talked to last. He's doing 114 and he's not profitable and he's not this and he's not growing at that rate. We're not going to mention those things, right? So it's funny. They amalgamate all the best statistics from each person they talk to.
Yeah. And what we gain out of it is like, you know what? We're going to work hard with our customer success team and work on our expansion revenue, right? So now let's work on an expansion revenue. And we know maybe it's not 114, but 105, 107 is a good net expansion percentage for us. Let's drive towards it.
Yeah.
We've invested so much into our technical debt to get that going. It's time to turn our gross margin from, the high 70s to the high 80s. Let's drive towards that together. But that's what is about building a business. Like Google didn't come out day one and their gross margins were fantastic, and this is what their net retention and their revenue was. Like everybody had to figure it out at some point, right? So,
and it looks easy when you're at 5 million and looks even easier when you're at 10 million. But to have built a business from scratch and assemble the team that you have is a hell of an accomplishment. And it will be great to watch Zoomph as it continues to perform going forward. It'll be great to see the press release when that comes out, which will be, I don't know, in the next month or two. So congratulations on finding the right partner. Congratulations on the success you've had year to date. If you're listening online at secondbitepodcast.com, you can get the show notes. You can see a nice photo of Ali. You can see his LinkedIn profile and the rest. But Ali, it was generous of you to share the time and to share as openly is always great for founders to listen and hear from somebody that's had the experience. So thank you for carving out some time and being with us today.
And no, thank you for sharing this platform to get these experiences out. We've learned a lot listening to these podcasts, and you do a great job sharing all this wisdom out there. So I hope everybody could take not just some experiences here, but all the other experiences you put out there are very valuable. You just got to stitch them together the right way.
Yeah, it's great. It's such a good community, the entrepreneur community, willing to share experiences with others. And I'm thrilled just to be a resource to provide some of that. So Ali, thanks again, continued success, and we will stay in touch to watch and monitor your growth.
Thanks for listening to the Second Bite Podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.